Garth McNally.
Good morning, Jim. How are you today?
Very well, thank you, sir. How's life treating you in isolation?
Mate, coping as best as we can with two young kids in the family.
Yeah, it's been an interesting month, really. Trying to manage a business, kids, online education, Zoom meetings, dogs barking, lots of interruptions. It's a different way of living, different way of working.
Sure is, mate.
But mate, amongst all this chaos, there's opportunity, that strategy opportunity that we've been discussing, and I wanted to sort of put together this little video with you to kind of start to outline how we can sort of put some of our self-funded retirees perhaps into a better position if they're in the right space. And specifically referring to the 50% minimum pension reduction that was put in place by the stimulus, which was really about trying to prevent our retirees having to sell down assets in order to meet their minimum pension requirements in pension phase, which was a little funny, I found, because all of our clients have never been in a position where they would have to sell any assets down in the event of a market downturn. But nevertheless, there's an opportunity there, Garth.
Yeah, look, mate, I think it's a positive step by government to introduce this the reduction of 50% in the minimum drawdown of pensions. Positive move like we had back in the GFC. But it is also interesting and good to hear, Jim, you saying that your clients probably won't really be affected by a lot of that because their assets are well managed, their cash flows are well managed, and therefore they don't really need to sell at the worst time.
Yeah, we always have the right cash reserves, and our asset allocation across the different asset classes is built specifically to make sure that never happens. So I'm sure that's the case across the board for a lot of people that have got their funds under advice anyway.
Yeah, look, the whole thing that led me to have a chat with you a while ago was there's been a lot of press lately. You mentioned around pensions. Should clients be starting pensions? Should clients be stopping pensions? A whole lot of press, which has sort of been getting a bit upsetting when it's sending, to me, the wrong message to a group of clients.
So Garth, just to put everyone in the right frame, the reason we go into pension phase, or the opportunity that's available when we go into pension phase, is basically to be put into an extremely tax effective environment. So if you're over 60 and fully retired, or over 65 and still working, we're able to start up an account-based pension, and all earnings are tax-free, and any income that you should draw out of that for lifestyle isn't subject to PAYG income tax. So it's a beautiful, beautiful place to be. However, we know that there are contribution caps over the life of superannuation to allow people to get the maximum amount into superannuation allowed. And the reason those caps exist is because we pay more tax outside, and that's where the government gets a hell of a lot of revenue that goes towards all of our necessary budget expenses, etc., in our economy. However, there's a $1.6 million pension cap per member balance that is allowed to live in this tax-effective environment. However, with the current opportunities and the way this transfer balance cap works, we've got some strategy to discuss. So what's your take on that?
Yeah, Jim, 100% agree that you've just sort of been through. The tax-effective nature of pension phase is fantastic. What I'm looking at is really those clients that may have been looking to commence pensions in the short term, but have now been, by dropping market value, not having to start a pension and then draw down on their capital when it's at a low point. I understand why there is some press out there at the moment suggesting that delaying starting a pension is worth looking at. But the two main things you just mentioned, the 1.6 million limit on moving money into pension phase, and the tax-free status of earnings in pension phase, to me, can't be written off. I was approached by an advisor in the network late last week who picked up a client who was, for instance, had been given advice to start a pension, but now that advice was to delay that, not start the pension. And I asked why. Why is that the case? And in this case, the gentleman's name was Dave, from memory. He had about $1.9 million in his super fund back, let's call it January, February. And as of sort of today or earlier this week, it was more around about the 1.5, 1.55 mark. So a fair bit of short volatility.
It would have been 1.9 on the 24th of Feb, mate. If you have a look at where the market started to drop, that was the magic day. And it kind of hit its bottom so far at about the 24th of March. Been rebounding a little bit. But, who knows what the next little bit of roller coaster will play out for us. Sorry.
Important when you think about this being a short-term issue. But what opportunity is there in this short term? So with this particular client, I took a different view and said, what if we actually did start the pension as initially planned? Dave would move his $1.55 million from his accumulation account into a pension, and is essentially what I refer to as buying his transfer balance cap, buying $1.55 million worth of pensions in what I assume is a market that will go up over the next couple of years. Even if we took a conservative view and just said that in Dave's case, what if he just got back to where he was? So if he buys his 1.55 million pension now and markets do recover, they go up, all of those earnings are going to be in this really tax great area of pension phase, right, on the earnings.
Beautiful.
That not only is great for Dave, but you also just need to keep in mind that all of those earnings that have been generated on that pension are actually allocated to tax components inside his pension, being the tax-free and the taxable component proportionally. If Dave didn't start the pension, they would all go to the taxable component in the accumulation phase.
Right.
What we're really getting is a bit of an estate planning play, where the growth in his pension will also grow his tax-free percentage.
Beautiful. Absolutely. In the tax-free component, adult beneficiaries don't pay any inheritance tax, if you want to call it that. So the higher the tax-free component, the better. And in this instance, as markets recover, proportionately, that's going to be applied to both components, and it's going to increase the tax-free component. Which was reducing the tax in a state to the adult beneficiaries. I mean, it's fantastic.
Yeah, when I crunched some numbers for this particular client, I think there was in tax-free component of about $120,000 by moving into a pension. Now, look, to be transparent with that, I mean, if markets went further down, if they did, then the taxable component in the accumulation is going to drop, right? So who knows? I have a crystal ball, and I don't really worry about that. I'm looking more about a longer term outcome for a short utility. The other thing that we looked at for this client was the initial advice to start the pension was that if he wasn't going to spend the pension money, he was going to recontribute that back in for his spouse, which is a great idea. It'll go back in the tax-free and non-concessional, so again, estate planning. The other most important thing that we picked up, though, was let's just say in 2-3 years' time, we get back to 1.9 or hopefully higher, and Dave decides, I'm going to keep working, I don't want to keep taking pension payments. He can stop it. He'll get a debit to that pension account, that transfer balance account of $1.92 million, meaning he's essentially purchased or bought $400,000 more of tax-free earnings capacity. Now, we're not doing this. We're not doing it just for a tax strategy or a tax plan. It's actually all of these things: the estate planning, the pension planning, and the component planning. And I just think it's so simple. It won't work for all clients, but being a simple strategy, it usually has a big application.
Well, absolutely. So it's the call to action to our accountant partners or financial advisors out there with clients in that situation. So in sort of pension range, if they had larger balances above the transfer balance cap of that 1.6 million, now is the time to take advantage of the drop in markets and actually flip it into that tax-free environment so that the growth is captured under the transfer balance cap provisions and into a tax-free environment. So we should be looking for these opportunities for our clients right now. Such catastrophe happening out there with small business and personal cash flow and things like that. It's easy to forget that this is still an opportunity to look for strategy for our clients, and we should get onto that as soon as we can.
Yeah, you make a point there, Jim. We often talk about market timing, risk of being out of markets. That has massive application here. The longer it's delayed, higher our investments grow back again, and let's hope they will. We know they will, but we want to try and get as much, as you said quite clearly, as much of that growth now in the right area. Mate, sounds great.
Good on you, Garth. I really appreciate your time. Well, I look forward to seeing your face to face very soon, mate. Thanks very much.
Mate, thank you for your time too, mate.
Good on you, Garth. Cheers.
See you.